Patrick and I just finished recording with our friend Coty Dolan. He came prepared to talk about macro, micro, real estate, financial advising. We hit it all in this one. A lot of informative tips that we came across, and I think you guys are going to like it. Patrick, what do you think about today's episode? What'd you walk away from our conversation?
Oh man, today was an absolute great episode as always. What I walked away was a better understanding of kind of like where the multifamily market is headed and how we will be able to capitalize on it within the next 6 to 24 months. So make sure to listen to the end. He gives some great resources on some pretty obscure like books and different things in the big four that I think you guys are going to love. And here it is. How's it going, everybody? And welcome back to the Real FI podcast. I'm your host, Patrick McGrath, with my co-host, James Rippion. How's it doing today, James?
Going well today, Patrick. Thanks for the intro. I think we're going to have a great conversation today, like we do every week. And without further ado, let's go ahead and get our guest introduced. Coty, why don't you tell us a little bit about the things that you've got going on? Tell us a little bit about yourself and just introduce yourself to our listeners.
Yeah, James, Patrick, thanks for having me on, gentlemen. Should be a fun, exciting episode. A little bit about me. My name is Coty Dolan. I'm an investment advisor and realtor in the North Houston area. I've been investing in real estate for just 3 years now. And what I got going on right now, I'm in full building mode. So I'm just turned 33. I'm hoping to really have a nice cushion by 40, have a little more freedom. But right now I'm building. So I'm building the real estate business, building the financial advisory business, and investing along the way.
That's awesome. That's awesome. So tell us a little bit about your background. Like, it sounds like you got like multiple things that kind of tie in together, kind of going on. Like, what kind of got you down this path?
Absolutely. So first, I was in hospitality and I was absolutely miserable. I got a good salary job as a food and beverage director, and I was terrible. So I had a buddy of mine. I think I was at a bachelor party, and one of my buddy's friends there was a real estate agent. I was like, "What? Tell me about this real estate stuff, man." So he kind of got me kickstarted in that. Got my real estate license and started investing. Knew that was the path to go. I more got my license to learn about real estate, learn about investing. Started off at a property management company, which was great because very unrewarding, unfulfilling job for at least for me. And but you get to learn a lot of really important stuff you need to know when investing in real estate. So when I was doing that, I was living in Monterey, California, the Central Coast, and I started investing in Tampa, Florida, because late 2019, early 2020, Tampa was still pretty reasonably priced, and you could get some good cash flowing properties out there. Was doing long distance investing, BRRRR deals, looking for the right flip deals out there. And then just through that, I started getting bigger properties, started working with some private equity groups, raising money for syndications, doing apartment syndications, and honestly kind of saw the writing on the wall when people were giving away free money at like 2.5% for there. And we actually, I lost a good amount of money in a deal was it last year, maybe early last year, where the interest rate shot up on us. But actually, so we're starting to exit the apartment game as things got super expensive. I'm sure you guys know everybody and their brother was doing syndications, throwing money at apartments, and multifamily was nuts. I got recruited at a financial services firm to be an investment advisor. And I was like, you know what, this is probably a good idea. I have been investing in stocks and stuff like that for a while as well. So right up my alley, and it's a match made in heaven.
Well, there's definitely a lot to dig in there. I think a good place to start might be with some of your experiences with the property management side of things, because, I know that's really where you get into the down, dirty, nitty-gritty of real estate. You get to see all the ugly aspects of things that are going on behind the screen when it comes to this industry. So, why don't you tell us a little bit about your experiences there what you learned and what you took from that employment opportunity.
Absolutely. I'll start with like biggest light bulb for me that happened there was I remember meeting just I first became a portfolio manager where I was managing multiple properties and talking to owners and stuff on my own. And I remember calling a guy who owned I mean, in retrospect, it's not even that big of a building, big for the market we were in, but it was 20 units. I remember thinking like, no, like corporations own apartment buildings, right? And then I remember just talking to this dude who's the most casual guy ever, and I was like, people own apartment buildings. I was like, not just like banks and stuff. Like it wasn't even a concept to me before I started property management. And then just meeting more and more owners. They're normal ass people, right? There's everyday people like, oh yeah, I've just been picking up not everybody owns apartments. Some people are like picking up an apartment a year for 20 years. And then all of a sudden, like, oh yeah, these 20 properties, they're all owned free and clear now. And I cash flow like a mofo, right? That was the biggest thing, was realizing that anybody can make a good chunk of change in real estate.
I think that was one of the biggest realizations for me as well, is realizing how, like, the demographic of people that get into real estate, it's kind of surprising once you lift that veil. It's not a whole bunch of corporate bigwigs, especially if you're dealing with a small to mid-sized multifamily.
Yeah.
It can be average people, normal people.
Absolutely. I mean, and that's another thing is I'll say like today's day and age, people, I mean, the term landlord is almost a four-letter word, right? Like people really demonize the rich these days. They demonize landlords, especially. I mean, I moved out of California for many reasons, but man, during COVID, like people didn't have to pay rent. People were getting checks, and most people didn't stop working. Yeah, some people really had financial hardship. And I'll say from the property management point of view, like we had every single one of our owners when COVID first happened, reach out and be like, hey, let people know it's okay. They're all right. I got cash, right? But some owners are month to month also, right? Some owners are covering their expenses. There's not just a mortgage, there's insurance, there's like upkeep, there's property management fees. There's a lot of fees and stuff that don't go into it, or that go into it that people don't think about. That like it's not like every owner's Grant Cardone flying on a jet, right? Like some people their margins are pretty razor thin there.
Yeah, and unfortunately, I think that's now what we are seeing in the multifamily market with a lot of the syndications that went on and people that got in with the expectation of rents continued to raise, bridge loan debt. Now we're getting into that refinance game where people bought at 3% and 4% and are having to refinance at 7 or 8 or put more cash down. And you're finding the people that don't have the reserves or were kind of living that hopium dream, everything's kind of falling, crashing down around. I know for us as being smaller funded landlords, like that was kind of the position that we were at. We were like, look, hey, to our 30 tenants, hey, if you have an issue, just let us know. Open line of communication is the best thing. But that's kind of hard when you have a couple hundred units, to do that. And some people taking advantage of the situation. Is that kind of what you had found when you were going through that whole thing?
Absolutely. Like smaller ones, people living in a home too, or it's a little more intimate, maybe I felt like. And everybody's good. We also had everybody, I think we were at like 97% rent collection too. And like that 3% was almost the standard. They weren't paying anyways, right? They were late on rent. So it wasn't that bad. I will say one of the buddies in my office managed a building in San Francisco and they didn't pay. Like San Francisco got absolutely destroyed. I know. I have a friend who's a sweetheart. She owned a building in San Francisco. There's 22 units, and she had to pay 18 of the tenants $200,000 each to move out. And like, wasn't like hardship people. Like these are all like tech employees still getting their salary and stuff. But it's like San Francisco. I think there's a few other cities, right? They were like, nope, no more evictions. And it's like that's all these headline policies that go out in regards to housing have like, yeah, in theory, right? Nobody wants homeless people. Nobody wants people not getting kicked out, not being able to pay their rent. But there's huge repercussions down the road for putting things in like an eviction moratorium. That moratorium, is that the right word? I'm trying to sound smart here.
Yep.
No, that's exactly the case. So with seeing the writing on the wall with some of that while you were at your property management company, is that kind of what led you down the path to go to a more, let's say, investor landlord friendly state like a Florida?
Oh yeah. Well, one was right when I started at the property management company. I remember somebody's dealing with an eviction, and I remember it was like, yeah, in California, it's like 2 years. People got to stay in the house, just destroy the house. And I was like, well, I'm not buying there. I was also had no money when I first started. I was broke, like no money at all. And I was like, you know what? This is great. Reading all these bigger pockets books and stuff like that. I was like, I don't think the 1% property exists in California. 1% being the right, you can rent. The rent is gross rent 1% of the cost. And I was started learning market research, man, and like, all right, these are the markets that they say are good, that there's good stuff happening. These are the metrics you want to see. So started bouncing around and ended up on Tampa because I was, Tampa, many reasons. Tampa, very similar to Houston, was very business friendly. So during COVID, a lot of businesses, corporations started to move to both like Greater Houston, Greater Austin, Phoenix, Tampa, which jobs come with the businesses. So I was like, all right, I'm gonna start investing here. One, because I could afford it, and it had good like macroeconomic factors long term.
So let's talk about some of the deals that you were doing in Florida. Like what do the properties look like that you were working on, and tell us about some of those transactions that you had going on.
Oh man, I was doing buying class D properties, right? I was buying things in really bad shape, trying to getting things under 100,000, what we're looking for, and heavy rehabs. And in all honesty, I didn't see our portfolio, my wife and I, for 2 years. I think I finally went out there in 2022. I was doing business, started doing more, or 2021, maybe a year and a half. When I finally started doing apartment deals, I would go out there. But I mean, buying the single families and doing the rehabs from across the country wasn't a problem. But man, we I will say we got lucky how cheap money was during the time period, and we got to basically like some costly. Right now, I would have been underwater with like my first couple properties, the way I managed them. But it's a good learning, right? But so we go in buy kind of shit houses, do a large amount of work. So probably buy houses 2/3 value and put a third of that money in, and then do the BRRRR thing where we just rent it out and then repeat.
How many of those did you guys do before you started stepping up into apartments?
Gosh, so we only did 3 single family homes then we went for a triplex. And then after that we went to apartments.
That's awesome. So what was the time frame in between there? Like from buying your first single family
2 years.
2 years.
I'm so sorry, but it's honestly, man, it's more expensive, right? Especially when you like the risk capital, but it's the same deal. There's just a few more numbers to crunch. Once you get your analysis down, I would say that's the biggest part. Once you can be able to, just like if you're buying a single family house, if you're buying a quad, if you're buying a 100-unit apartment, you need to be able to analyze enough of them and see them so you kind of know what you're seeing when you look at numbers. And it's a different game to learn to play at the higher ones. The agent, you use lawyers, you don't use as like 2 agents. The forms are all drafted. A lot more is on you. as far as the single families, you can pick it up pretty quickly, and then just having the faith. Like sorry, excuse me, you got to develop a team for both of those, right? Multifamily or single families, because if you got a good team, property manager, you got a contractor. I mean, you got those two, and usually your property manager should give you everyone. Like if you have a good property manager, they should have a contractor. They should have every sub available, and they should be managing your rehabs for you. So it's an easy way to get in. Like I said, it's a thankless job, and property managers are probably the most underpaid person in real estate.
Yeah, it depends how you organize it for sure. Once you start managing rehabs, like it really sucks a lot of time out for sure.
Yeah.
So that's to be expected. But if you do it right, you can turn it into a profitable business. I mean, that's why it is a business as well. So
Yeah. No, exactly.
it does take a lot of work, and you're going to take a lot of beatings from the tenants and owners along the way. But it's just part of the business. So do you still own those 3 single families and triplexes, or have you since kind of liquidated them and moved your capital?
No, we've liquidated everything right now. I'm pretty heavily positioned in securities right now, and waiting on the sideline. Myself and another group are waiting to be opportunistic about what's happening with apartments right now. I think Q4 through Q4 2024, there's going to be a lot of these, like you mentioned earlier, these people that are having to refinance, seeing a lot of assumable debt deals. There's going to be a lot more opportunity, and just buying right, being able to get things at good prices where the owners aren't valuing them at projecting 20% rent increases year over year, and the debt is going to be a little more reasonable. It's going to be more expensive, but like it's going to be more reasonable.
Right. Well,
Right.
and I think that's what's so interesting with this industry. It's slow to move. Like the prices are not going to be felt right away. And I think, the expense of debt is really what's going to be moving a lot of the commercial real estate prices in either direction. The single family stuff, it's odd because there's going to be so much demand for it anyways. Like there's few properties available for sale to begin with, that prices are still going to remain elevated, but this commercial stuff has to retrade based on the debt, every 5 years.
And man, people were not underwriting 7-8% interest rates in 2019 through 2022.
Exactly. So how did you, I kind of want to take a step back here and ask, how did you go from 3 single families and a triplex into, what was your first large apartment building size and price, and how did you make that work?
So let's see. I made the jump by, I remember having a friend, I think I met him at a real estate conference, just a local friend, somebody basically being like, hey, it's the same thing. And I was like, another little light bulb, right? And so he was like, all right, I need to learn to do this. I actually paid for a mentorship, and then really felt like I dialed in how to do it. Started working with a private equity group who was like, yeah, we're buying apartments in Florida. And I was like, hey man, like I can help you find deals. I know how to do that. Just really wanted to get experience on the team. Worked on an acquisition of a downtown, what is it? I believe it's called the Heights of Tampa, a 126er. That one basically just deal finding and boots on the ground. Made some introductions, and that's how that deal went. From there, I went on to, I lost money in a deal where we were going to buy, I was the principal on the deal. We're going to buy a deal a little north of Tampa. That was 5 million, 50 doors. On that guy, the interest rates just started climbing. They went up like 2 points in 2 months on us while we were in escrow. And I was like, hey, had to go back to my investors and be like, hey, like, in no way we skin this cat. Is this a deal anymore? And like, couldn't get to, basically we had to renege on the seller and ask him for like a ridiculous reduction that I knew they weren't going to give. So we ended up just walking away from that one. And then from there, worked on a deal large deal in California with a group. What was that? That one was another boots on the ground deal where I wasn't putting up much, but just helping with the due diligence side. And that was in Walnut Creek area. And then just worked on a deal in Orlando the end of last year. So,
and you found your way to back to California, man.
dude, it was so funny. I was totally moving to Texas too. I had already like shipped was like signed a lease in a couple months and was leaving. And then I had a friend who was like, yo, we want to buy this building. Can you come check it out with us? And I was like, oh, I was about to be flying back and forth. But luckily it worked out.
So let's talk about that 5 million, 50 unit, $5 million deal, 50 units that you had to walk away from, because, you know, I'm sure that you guys had some time, maybe even some money invested into it. So did you guys lose any funds? Did any money go hard that you had to walk away from, or was it pretty easy to kind of get out of it?
Yeah, I think I lost like 120,000 on the deal. Being the principal, you have a large upside, but you also put up all the risk capital, right? So paying for title, paying for survey, paying for all the inspections, all the people's time, getting quotes on stuff, and then of course the earnest money deposit. So we were hard with our earnest money, and it's like the sell we had extended a few times, and so this was from time frame. I think this is last year from like March or April to the end of June. So we were just getting wrecked with rates. So we're going back and forth negotiating. And then every week that passes, the interest rates go up. And it's like, we're like, okay, well, we have that price. And now it's like, shoot. And yeah, my partner and I were like, yeah, at a certain point, we're like, there's no way these numbers work. Like we could pretend that we're gonna like flip the units and get them released at higher prices as much as we want, but at a certain point, like numbers don't work, right? And that's it was great learning because I also realized that some people are going to be hurting from their projections here.
I was going to ask, so do you know if that property ended up trading?
Oh, it ended up trading. Like 6 months after we fell out. And it ended up trading, I believe, like 700,000 less than we were going to have it for, which by my calculations still wouldn't have been good for us. We wouldn't have been able to hit. I think honestly today, if we did the syndication today, our investors would have been okay with like those numbers, because now in 2023 the expectations is a little more down to the ground and reasonable with returns. Now you just want to get, I mean, people are happy if they're getting 7-9% these days.
Right.
At the time you're getting those syndications promising like 22% IRR and stuff. So yeah, but the numbers just weren't working.
Yeah, I mean,
but that would hurt. That would hurt.
I was gonna say, when you've got like a 3-4 cap, which is probably crap, probably a good way to call it.
Yeah.
And then you got these treasury bills yielding 4, 5, 6%. Risk-free quotes. It's kind of a hard decision to get into those low cap rate properties, at this time. So, it's interesting. I'm very curious to know, like you're projecting, to see where things end up at the end of the year, beginning of next year. It might be a good opportunity for those who are a little risk adverse. Who knows? But I could also see prices keep going. That would fit the narrative that could expect.
And that's just like, that's the economy. That's investing. Is everything goes, it's all cyclical. So some things get too hot, then they got water poured on them, they cool down, and it all goes like this. Sometimes stocks are way overvalued. They're not a good investment. And then you want to wait till you get a discount. Same with real estate. Sometimes real estate is priced up here. Everybody's throwing money at it. The biggest comparison, I think, to what's happening or going to happen right now with commercial is the .com bubble, where everybody was like, okay, websites, we're throwing money at them because this is where we feel we should be. And then all of a sudden people are like, wait, we weren't making sure they were good deals. That's kind of what happened, where, yeah, like, God, Miami was trading at like a 1.9 cap or something at that peak. Austin, the even the like New York's New York, but it's San Francisco is awful. But the newer ones were like Phoenix, Austin, Miami were just. I think Atlanta got pretty crazy at the end. Even Tampa, all of those cities are probably going to be hit the hardest because like the lower cap rate, especially the compression, excuse me, of the cap rate in those cities was so fast, so like
Well,
so quick.
I'd like to break for the listeners out there that may not understand the importance of cap rate and how it affects the overall value of a property. Okay. So let's say that that property in Tampa that you were going to buy for $5 million. Let's what was the cap rate you were looking at that time? Like 4, 5?
We were at a 5. We were at a 5.
Okay, so you were at a 5. So a 5 cap on that property at $5 million. Now, at a 6 cap, what would be the value of that property? You think? Just rough numbers.
4, probably like 4.2. Probably losing 800,000 on that.
Exactly. And then you get to 7, and all of a sudden it's a 3,
Like
4.
3.5, yeah.
3.5. So that is the importance that I want to emphasize to some people is like, not only are interest rates going up, but cap rates are increasing as well. So you have like a double negative. It costs you more money just to hold the asset, and the asset is losing a significant amount of value. To go from a 5 cap to a 6 cap, that is almost 20% haircut on the value of the property, and but it's also likewise the other way. So if you're buying on the come up and you get a 5 cap and all of a sudden cap rates squeeze down to 4, like you just hit a home run. And so that's kind of where the multifamily game is right now. And for the listeners out there that don't know as much about it, like that's really the importance of the cap rate that you get. And that's also the importance of that interest payments that you're getting. And right now, guys are just getting clobbered because you go to refinance, and not only is the bank taking you from a 4 to a 7, but you're going from a 5 to a 6 or a 5 to a 7 cap. And all of a sudden you are just annihilated. And that's why you're going to see a lot of these buildings trade. And like you said, I would like to get into the fact you were talking about maybe some assumable debt. So right now you're hanging on the sidelines. You've got your cash, and it sounds like your investment funds cash sitting on the sidelines and something that you consider conservative and safe, ready to pounce. So what are you looking for in the market that is going to get you back into, either syndicating or buying multifamilies?
Honestly, right price. We're looking for some people in some pretty bad spots, not necessarily a bad building. I like right now, I like hotels, small hotels. And I like multifamilies in the mid-range for the multifamilies. 50
What would
to
you consider mid? Okay, gotcha. I was going
50
say,
to 200.
Okay.
The 100 to 200 gets a little bigger, but we're projecting that 50 to 200 range is where most of the, say, junior syndicators are going to be in. And like you just mentioned, another problem with the expanding cap rates, as you're losing value on that with the gaining interest, right? Because a lot of these are adjustable rate loans. You lose the value to refinance out into a better loan. So even if like you're at a 7% like fixed for 10, it'd probably be better than the floating rate. Like what I think they're probably like 300 over SOFR right now. And people are going to just get smoked because you're building. It's like to like bring it down. So if people, sometimes multifamily is tough. Like if you buy your house and you have a adjustable rate loan and you're like, it's fine. So my house will be worth more money in 5 years. I will refinance before then into a longer term loan, and then I will have more money. Well, now you typically need about 80% to refinance into that. Well, now you can't, because your house is not worth more. Your house is worth about the exact same as when you paid for it. Also, the rent rises too are another thing that have stagnated that's really smoked it as well. So it's a storm for multifamily. So your revenue, which based on cap rates, with cap rates working against you, your revenue is also stagnating. Where we saw amazing increases, right? 19 to 20, 2021, 21, 22, and now bam, stopping. Like most places, Tampa was 22% for 3 years in a row, and then with I believe it was like a 5% increase last year. Wild. So pretty much all metrics you need to go in your way for apartments aren't. So yeah, we're looking for distressed things that say it was people's first deal or second deal and they kind of overextended. We're looking to capitalize on those distressed situations.
Well, it's not just, the mortgage loan rates as well. I mean, you've got general inflation going on too. So insurance premiums are going up, cost of maintenance repairs, rehab costs, like all that's getting jacked as well.
Yes,
And then
yes.
on top of that, and this is something that, admittedly, I didn't have a great appreciation of, and I think a lot of other commercial investors didn't either. Property tax reassessments. We've had this huge, massive bull run in property, price appreciation. I don't think a lot of these municipalities are going to sit on the sideline not collecting that revenue for too long. And I think that's something that was probably underappreciated by a lot of investors. It might still be to this moment. That reassessment is going to hurt, because I know that when I'm working with my clients buying and selling properties, I have to tell them, like, listen, this is literally assessed at 50% of what you're buying it for. So when that next tax bill comes, like, you're going to get smacked. So just be prepared for that.
Insurance as well. Insurance, especially. I mean, I'm on the Gulf here in Houston, but being familiar with Florida, like Florida insurance got wrecked in the Hurricane Ian, right? And oh man, carriers went out of business. The property insurance, which caused this whole ripple effect where things are stricter and they want more money. And man, some places have gone up like 300% their property insurance.
Yeah, I mean, and it's not all doom and gloom. I don't want the listeners that are
No.
listening.
These are all good things. These are all good things.
These are actually, I believe, positive for a healthy market, because it was getting out of hand. You could not open Instagram or YouTube without someone teaching you how to syndicate your first deal, and buy a couple $1 million property with no one else's money. And it gives the people the opportunity that have been doing the work, that have been doing the right things for the last 2 or 3 years, building their foundation, buying solid properties that didn't overextend themselves, that now have been sitting on the sidelines waiting for a good opportunity to come along. Now that opportunity is there, for you to start picking up deals for. I mean, I'm looking forward to possibly seeing stuff back in like the 60 to 80,000 a unit range, which in the north where I'm at, I think is very reasonable. That's where I was buying stuff, 2 and 3 years ago. So to be able to have that come back around would be really, really nice, because I don't particularly see rents decreasing very much, but I don't foresee the growth. So if you can get your cost basis down on your price per unit while keeping the rents where they are the same or projecting a very slight increase, I think that you're going to have a really good opportunity, like you said, to go in there and squeeze.
Oh yeah, it's the, like you said, the market, right? It's a cyclical market, and this is just a correction, and it really makes it's the beauty of our capitalist system here is that it creates opportunity. If it gets a little too dumb money, when things I read some book and they're like, when it seems like really stupid people are making a lot of money, it's probably the top of a market cycle.
Mm-hmm.
And I was like, oh damn, absolutely. That's another thing. Like I'm fairly young, especially my investing career. Well, I bet a lot of your listeners are as well, based on how spry you gentlemen look. But I thought back in 2018, 2019, I was like, I've missed it. I've missed the boat. There's not going to be another crash like in '08 where it created all this opportunity for new investors to jump in. Well, this is that crash. And they happen every 7 to 15 years. And so it really makes you, creates opportunity, but it's a great time to learn to invest because your numbers have to be right. And I mean, if you can find a deal right now, that thing's a deal. If you could find a deal, if your deal only worked at a 3.5% interest rate, probably not the best deal.
And I think the major
Exactly.
lesson for everybody is dollar cost averaging into your investment portfolio. Like you don't have to shoot your whole all your capital at one time to get into it. It's a long game. Real estate is a long game. You know, buying one deal, two deals periodically over your lifetime is what's going to make a difference, and it's going to help you weather these economic storms. And it's not going to phase you as much. But you know, everybody who's getting into it at one time when it is a little manic, you know, maybe cause for some concern for their portfolios. But you know, otherwise, people who play the long game tend to be the winners.
Yes. It's with investing, any dollar of investing money you put out there, you should not expect to see that back in 5 years. And if you're going to invest it, whether it be a single family house right now, say a short-term rental condo, if you're going to invest in some stocks, if you're going to buy ETFs, bonds, ask yourself, is that going to be worth more in 5 years? And is this the best more of all the options I have? Like, what is the best one to put this in that I'm going to see the most in 5 years? If you look at real estate like that, that's why it's so great. It's because, I mean, things have to go really bad for you to be like, man, if I buy this house, it's going to be worth less than 5 years. I mean, you might take a haircut on years 1 or 2, right? Maybe you're not cash flowing, but you know, there's going to be another time that people go crazy in the market again, and you're going to gain like 100 grand of equity in a year.
So, with your position in financial services, like, of course, this is not investment advice for anybody listening, but you know,
No,
what
sir.
kind of things are you interested in right now? Like, where is your money specifically as you're waiting for that real estate opportunity to kind of present itself, maybe in the near to midterm future?
So I always ask myself before, at the final evaluation of a company, because that's what you're doing when you buy stocks, is you're buying a company, you're becoming a part owner of the company, and just ask, what do I want to be part of this company, and do I want to own it forever? And so that's really my investment criteria when looking for stocks. I do think that now is a very good time to enter the market. Even if you look at some blue chip stocks, they're incredibly discounted compared to their highs of a few years ago. And I mean, if we just look at the blue chips to be safe here, but just look at their charts over a 5 year time horizon, right? Same with real estate. Like over 5 years, everything's going like this in the United States of America. Over 10 years, right? If you just expand charts out, it's going up. So I think it's a really great opportunity for people to get into investments, get into securities, and right now, in a safer way, right? No investments are safe, but you're also not. They're a lot safer than buying FTX coin or buying Bitcoin at 60,000. When I say, like, the Bitcoin thing's a whole nother thing. We could have an hour podcast about that. But being able to just buy something that's cheap, because retail investors, I classify as people that really don't know what they're doing. They invest because they hear people say they should invest. These are those people that are getting smoked on some syndication deals in the next little bit, but they just get so worried about headlines. And headlines have nothing to do with the money you're going to make. It's all about, is this a good company? Is it going to be worth more in the future?
Exactly. I totally agree. I think that is a sound strategy for those out there. And like James always says, you know, dollar cost averaging, continue to put money in your 401k, continue to do your investment strategies, because This is a real estate podcast, or mainly focused real estate podcast, about financial freedom, financial independence, but everybody has their own way to get there. Whether you use real estate as a vehicle, whether you use stocks, Bitcoin, mining, crypto, like all the different ways, short-term, long-term, there's so many different ways to slice it. It's just getting in the game and making sure that you understand the fundamentals enough to make an educated decision based on the data, and that you ultimately feel good about your returns. Because like you just said earlier, 2 years ago, people weren't putting in their money for something less than a 20% return, on these syndications. Now they'd be happy with a 6 or 7, and I'm sure a lot of those people that went for those 20s would be really happy right now with a 6 or 7 that wasn't falling apart and them losing their money. So it's what makes sense to you, your risk tolerance, and all of that. And I think that's one of the beautiful parts about investing, is that it's a personal journey that you happen to be in the driver's seat for. And we're all here to just really show people the different ways that other people are investing their money, that other people are doing, the strategies that they're taking, the knowledge that they have, and kind of sharing it with everyone so they can kind of, figure it out on their own, with some bumper rails there to kind of learn from other people's mistakes.
Beautifully said. Yeah. I mean, it's all about educating yourself on what metrics to analyze. And beyond that, it's not much beyond that, actually. Like, it's just first self-educate. Anybody can learn this. The richest investors in the world all taught themselves investing. There's a few books out there. This is any type of investing. There's books, thousands of books on every asset class, every type of investing. Like, just listen to podcasts and educate yourselves, find out your metrics, and jump in. Make sure you do some learning before you jump in.
So let's talk about yourself a little bit and where you're going to be taking your wealth future in the short to medium term. So like, tell some of your goals. Like, do you have goals with regard to some of your financial services things that you got going on, or the real estate long term? Like, how many doors are you trying to get to? Like, break some of that down for us.
Sure. Right now, my strategy is I like single families again. So I'm pretty high on single families. I think it's a good time, similar to stocks, where they're at a good value. So it's a good time that you can pick some up, even condos, short-term rentals, single family rentals, where in the next 5-10 years, I think they're going to appreciate pretty well. So my strategy right now is we're trying to pick up two single families a year, be it standalones or condos. Midterm goal is I would hope to get it closed on an apartment building, let's say 50 to 100 units by the end of 2024. And then my long-term goal, 5-year goal, is I hope to be liquid about $5 million, and I want to start a hedge fund with that.
That's a great goal. I mean, and I love the progression there on how to be able to do that. And within that plan, is that to be able to pick up that 50 to 100 unit asset to ultimately liquidate it before the refinance to get you to that, 5 million in liquid?
Yes. I in that in my mind, it's a 5 to 7 year horizon. I'd like to put it up a little closer, because then I probably will hit it at 7, but I'll get a lot done in 5. But yeah, I'll probably do a big liquidity event. I think we'll be close to a good time in a market cycle in 5 to 7 years, and do a large liquidity event, and not take everything, but take a lot of what I have and put that into. One thing I learned with the syndications is I want to be putting a lot of my money next to my investors' money, as opposed to just using OPM for deals.
Makes a ton of sense.
So tell us about this hedge fund, because I'm kind of curious. You had mentioned that. So what does that look like? What would be your involvement with that? How is it structured?
Sure. I would be the CEO. It would be a pretty small firm of associates, and we would implement both long and short equity strategies. as well as invest heavily in real estate. I would heavily being 30% of our portfolio would be in Class A real estate assets. I like hotels. Probably are going to be better for that based on what we'd like to see as far as returns and stability. I like hotels because they're managed by name brands that you can trust. It's a big part. And I mean, I'm right now investment strategy is a little less like swinging for the fences, right? Like we're happy leading the league in doubles. Probably get a bigger contract than leading the league in homers for 1 year and then kind of falling off. I like analogies. I'm sorry, but with that, and that would be the strategy. I mean, some hedge funds do that now. For those that don't know, a hedge fund just does whatever they want with investing. So like a mutual fund has really strict strategies with investing. There's some funds that only invest in that only short companies. So basically you come up with an investment strategy and you show your investors why your fund is going to beat the market. And that's what hedge funds do, is they're trying to beat the return seen in the S&P 500. Some of them aren't. I mean, there's so many different fund managers now. And some people are like, I only invest in infrastructure businesses. So it's like a little different. So it gives accredited investors just another outlet to put their money into.
Gotcha. Yeah, that's extremely interesting. So what motivates you? What's the motivation behind all of this? You know, is it the money? Is it the win? Is it the family? Like break that down for us and let us know like what's really driving for these, you know, huge goals.
You know, I have everything I ever could have imagined I would have had now in my life. I have an amazing wife and an amazing daughter, and they're pretty much my world. I have a beautiful house here in Texas. Nothing crazy, but I'm a very blessed man. But now it's just really trying to maximize my potential. I absolutely love business. I love investing. I'm obsessed with it. It's my favorite thing. Like my wife, I try to stay off social media, and my wife's always like, what are you doing? I'm like, oh, I'm looking up this company's balance sheet, or analyzing a property or something like that. Like this is what I love to do. And then, you know what, I think it'd be a pretty sweet story, just to inspire other people that, I mean, I didn't grow up like dirt poor, but we were pretty meager means. And I think it'd be cool to get Ed Milet money, a few $100 million. And I think I can do that. Being a billionaire is a lot of work. I don't think people realize how much work it is to be a billionaire. And I want more of a family life than that. But I would love to have a big office building with my firm someday, be able to travel wherever I want, whenever I want, go to F1 races whenever I want. It's living an exceptional life with my family is my motivation.
I got to be honest. I don't want to work hard enough to be a billionaire like myself.
No, man. Like Elon Musk has a rough life. Like I like going to the gym. It like keeps me sane. I was like, so I can't imagine like working like Elon Musk or Mark Zuckerberg. Like that's what they do. Like, and they're like 18-hour days, as meetings. I like working, but I mean, man, I got into investing because I got into investing because I was like, I want to make as much money and work as little as possible. And that was it. I was just like, I hate working, but I also want nice things. So I was like, I need to learn to be an investor. And now I love this shit. So it works out, and I love being a realtor. I love helping people with their finances. It's and educating people on investing. I think what you guys are doing is great. Like things like this is how anybody, like podcasts like yours, is how anybody you can get motivation and education to do what all of us do, what anybody does. You can change your life.
Exactly. I love that. So I really want to get into right now, like what obstacles you see yourself facing just over these like next 24 months to kind of propel you to hit and work towards those goals.
think this is a time game, man. I don't really feel like I have anything in my way right now. I mean, capital is always nice. Anybody's listening and wants to invest in the Houston area or needs some help with your finances, let me know. But I know I know the path I'm on, and right now it's investing, right? It's a time game, so I'm gonna let things appreciate in my life for a little bit, and I I mean, if somebody wanted to give me $5 million, that would be great. But just accumulation of capital. I think that's the whole name of the game, right? That's the only thing standing in my way is how fast I could accumulate capital.
Right. Yeah, you got to be productive, and then you got to be patient. You know, and it's pretty much that simple. Yeah,
Pretty much it. That's it, man. It's like, all right, I kind of know, and you keep learning, right? I stay active in all the realms, but yeah.
yeah, that patience thing, that's something that I need to work on myself because I'm always zipping around between different opportunities. So whatever that's
I
worth.
uh, I heard somebody say you can do anything, but you can't do everything. I was like, damn it, you're so
Yeah.
right.
That's so true. I'm actually kind of happy at this particular point because I've had a large majority of my capital tied up into a building recently that has been taking way longer than I thought was going to take. And I'm like, all right, well, this is kind of a good thing because I know it's there. I know like
Yeah,
this project is going to work out, like everything's going to be fine. So by the time that everything kind of goes full cycle with it, will be kind of like right at that time where I think a lot more opportunities are going to be coming. And I won't, I won't jump on the first thing because I just don't have the capital there. So I think it might pressure me to be more patient over the next, 6 months to 12 months, knowing that's like, oh, I have this money over here, but I just don't physically have it. So, and I think sometimes that's what you got to do, deploy and sometimes, like you said, with your stocks, like just have it sitting over there, knowing it's ready, but you don't want to make it so easy that the first thing that comes on board, you kind of go after. So
Right.
I think that's kind of where all of us are at right now with that patience
well
thing,
said.
James.
Yeah,
Well
and
said.
I don't want anything that I've said to convince our listeners that like there is any kind of doom and gloom situation out there. My only intent is to say, be cautious and be patient and make sure that the properties you're buying, the assets you're buying are going to work long term. And that's going to be the same case for bull and bear markets when everything's up or down. You're going to have the same criteria. You just need to stick to it, and not compromise that. Just like Coty did when he let that one property go because it didn't match his criteria. He stuck to his investing principles, and hopefully in the near future that's going to have proven to have been the right choice. And I think a lot of people get frustrated in investing by not taking down that next deal, but sometimes that's the best thing to do in investing is nothing. So just take that and kind of digest it, and do what's best for your own personal financial situation.
Yeah. And
For
I
sure.
think that this is a perfect segue, with everything that we have going on to get to the next segment of the show that James and I like to call the Big
Big
Four.
four.
James, take it away, my friend.
All right, Cody. So, what's something that you do that is a financial independence hack, something that's a cheat code, something you apply in either your personal or your business financial situation?
Ooh, that's a good one. Let's see. A hack. Taking responsibility for everything. Everything's your fault in your life. So as soon as you can be like, everything in my life is my fault, good or bad, it'll change your life. I think that's the biggest one.
Yeah, I love that.
I absolutely love that as well. And I think a lot more people need to hear that message because there's quite a few people out there playing the blame game, but not with the person in the mirror. So I really appreciate you throwing that out there.
Yeah, man, it's so true. Like I remember one time, I was like really struggling with my weight. I was like, I always worked out a lot, but I went through that period, like mid-20s male who stops playing sports, right? Who gets a little fat. And I was like, man, like I was just down on myself. I was like, oh, like I try so hard. And then I was kind of like, do you? Like, you eat dessert every night. Like, you eat cookies and ice cream, like, every night. You drink, like, every night. You really try really that hard? And I was like, you know what? If I actually tried, like, as hard as I thought I was, you probably be making the progress you wanted. That's my personal real world example. So many things, like anything, man. Like, you get, just take responsibility for everything. Like, you could have left the house earlier. You could have like given yourself 4 reminders instead of 2. Like, there's so many things. Just your life is your deal. Be the king of it, or queen.
I love that. I love that. James, number 2. Oh shit, that's Pat, number 2. Look at me. I'm so caught up in that taking responsibility. I'm like, oh crap, throwing it to James. My job. All right, we call number 2 resources. So, are there any specific books, podcasts, or people that have really shaped like your financial independence journey? You know, that our listeners may not have heard of, like just your personal like go-to book, podcast, people that have really shaped, you know, your way of thinking and your financial independence journey.
Yes, I mean, so there's some obvious ones. Bigger Pockets is great. I haven't been on in a while, but I really got started with them. An obscure book that is amazing. It's called The Science of Getting Rich by Wallace D. Wattles. Older book, great book, amazing. I recommend that one to everyone. Podcast. I mean, I'm a big Ed Milet guy. I think he gets a little out there with some of his guests. He's just the nicest guy, and I feel like I'm so time conscious. I'm like, Ed, I can't listen to you and this guy talk this week, but most of his stuff's great. He has great books. Another for people just starting out in business, Alex Hermosi's podcast is pretty good. I like that too.
Perfect.
Yeah, I really like Alex. I think he's got a great message, and I do love Ed Milet. I'm not a regular listener of his podcast, but I do love the inspirational stuff that he puts out. I did get to see him speak. I went to one of the 10X Growth Cons with Grant Cardone, and he was one of the speakers. And I got his book, The Power of One More, which I think is just it. As you're reading it, every single chapter just hits you. Like, he's right. I can do one more of whatever I need to do, which goes right back to that personal accountability you talked with more. So I think those are all great. Everybody, go listen, go buy, go do that and shape that mindset. James, number 3.
All right, Cody. Future you. This is 5 years in the future. We kind of talked about some of your goals, but let us know, like, where are you? Where is your life personally and on the business side of things in 5 years?
So in 5 years, I believe I will have I will be very established in my financial services called work. I hope to be making at least 250K, but probably closer to 400K a year through that. And then in real estate, I would like to be at the point where I'm more managing a team of agents and not doing listings full time. And just like I said, I love the business side of things. So in both those realms, working more of a management role. I will also be really working on like I said, the liquidity event to get things going, get registration going with starting my fund.
Fantastic. I like it.
I think that's awesome. Well, Coty, it's been an absolute great episode. I've loved all the insights. I've loved all the deep dives we've got into a lot of the current economic situations, for the good, for the bad, and for all these wonderful opportunities that we see here. So if any of our listeners out there want to reach out, want to shoot you an email, you know, send you a DM or whatever, like, where's the best place for them to get in contact with you and let you know this episode expired then?
Sure. Let's see. Well, my email, it's simple. My name is spelled weird. It's Coty, COT as in Tango, Y. So Coty Dolan at gmail.com is my email. Instagram, I'm pretty big on Instagram, I think. It's Coty J Dolan at Coty J Dolan. Look me up on LinkedIn, big on LinkedIn too. I have a Facebook, but like that's probably the worst of social media. I'm pretty sure I have a Twitter too. Good luck finding me. I don't even know. I don't
Yeah, we'll focus on the Instagram, the gram.
Yeah, Instagram. Hit me up on the gram.
Slide into the DMs and let him know that he inspired you. And with that, you guys know this podcast is free. The information that we provide is free, but not quite. We do ask for one thing, and that is for you to let us know how we're doing. You can leave us a review on Google, Spotify, our website. Have you guys been there? TheRealFI.com. Or you guys can leave us a DM on Instagram. We appreciate you guys, and that's all we do. We work here every single week. We bring on guests for you, and the least you could do is go and leave us a review to let us know how we're doing. And with that, we'll catch you next time. Peace.
See you guys.
Boys. Thank you, boys.